You're listening to the Real Estate Runway podcast, powered by QUATTRO Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family. Today we have a friend of mine, Mr. Ian Djuric of Djuric Family Office. Very intelligent individual, literally from selling trash, building a company around waste, to owning commercial real estate in the effect of 7,000 units, building many, many more in terms of build-to-rent communities, and operating as a family office, which means he's a large balance sheet investor as well. Lots of nuggets on where we are in the market, how they're deploying money, how they work with larger institutional lenders and equity checks today and structuring their deals. Here's Ian. Let's get right into it. Here we go. All right. Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton. We're powered by QUATTRO Capital. And before we get into today's episode, folks, if you get any value out of this show, please scroll down, leave us a 5-star review and a thoughtful comment. Those ratings and comments are worth their weight in gold and the only way to increase the reach of the show. You can also follow us via our parent company, QUATTRO Capital, on Instagram, Facebook, LinkedIn, pretty much all the social medias at Team QUATTRO Capital. One word, no special characters, or simply by visiting us at thequattroway.com. We really appreciate all of you out there, and we'd love to hear from you. If you have any content requests, feedback, or just want to say hi, drop us a note at podcast@thequattroway.com. And if you want to apply to be on the show, visit us at thequattroway.com/podcast. Now on to your scheduled production. We're here today with a good friend of mine, Ian Djuric of Djuric Family Office. Ian, how are you doing today? What's going on, brother?
I'm doing great. I appreciate you having me. Just survived the Hurricane Ian down here in Naples. People are loving me for that. But I'm doing good. Still pretty active, trying to have a fun time. I appreciate you having me on.
Absolutely. This one's been a long time coming. I feel like between you and I, our schedules never line up. And this last one was, hey, man, a hurricane's going on. Can we reschedule? So I'm like, all right, I guess so. It is what it is. But, Ian, you are a force in the space, man. And I think that what I really want to get into today is kind of your take on the capital stack and how it's changing. But first, tell us a little bit about, yourself, your background, how the family office biz got started, and then maybe a little bit about what you guys are doing in the space after that. So let's start with who you are. Who is Ian?
Sure. I'll give you the quick 2-minute fast forward story. I started selling trash door to door, high school, college, went ahead and just kept moving up the system until I owned my own trash recycling company. Very much the entrepreneurial kind of spirit guy. I built up one of the top 100 biggest trash recycling companies in the US and Canada. I sold that off for a nice amount of money, kind of use that money to form our family office with and invest with. I stayed in the M&A space with the private equity company for a year or two afterwards, issuing wrap-ups and roll-ups. But we've been an LP investor in a wide variety of industries, but multifamily and CRE just really driven my interest. I wasn't a big stock and bonds guy. Hey, it's the slow way to get rich or slow way to retire. I wanted to try and make realistic money and have a couple doubles and later. I'm a younger guy. So I've been loving what my returns have been as an LP. And I was like, I built up a 9-figure company. I think I can do this too. So we came in and I went to several of my favorite sponsors. I said, hey, I'm going to write you guys the entire check for your syndication. However, I'm going to run it and you're going to babysit. And 2 of them said yes. So I got my 3 years of just hands-on experience running assets. I never did one of the weekend classes or mastermind programs. I just kind of paid for my education by sponsoring the entire deal and getting a basically hands-on every single day thing. I think the best education money can buy is doing. Now we have about 7,000 units, a mixture of Class C, but primarily Class A, 2015 and newer, kind of spread across the northern Florida, Carolinas, Georgia, Tennessee, and Texas. We have about half our units in Houston, Dallas, and San Antonio.
Wow. That's a pretty good 2-minute story. I appreciate that. So really quite literally from trash to real estate. So that's a pretty cool journey you took there. And I really appreciate what you said there, like being able to go in and say, hey, I know you're raising money and I'll be that check, but I need you to kind of like let me do this and help me know what I don't know. So that's probably the best education money could have bought right there doing just that. So, well, now that you own and operate, 7,000 units mainly in the Florida area, let me know kind of what other projects are y'all doing today? I know you play as LP equity, you play as an operator, and I think you're also developing. Like what is your family office? What methods are y'all taking to earn a return in today's world?
Today's market is very, very different than the past 2 years. We've been on a massive bull cycle the last several years. If you invested anytime before, you're making a killing. But now with the debt and equity market dramatically changed, it's kind of forced us to pivot. A lot of the operators and equity sources we talk to are just sitting out until Q1 of next year and have been sitting out the last 6 months. That's not been the case with us. So we've always done 1 or 2 developments a year because we're always looking for that more aggressive return. You look at your value add or traditional syndication promotes a 15 to 20% IRR. When you get into new construction, obviously you give up that cash flow, but you can look for a mid-20s IRR return. And so we try to get a mixture of that, of the higher IRR with no cash flow versus the other deals, our A-class deals that have cash flow. So primarily what we're doing right now is we're still building build-to-rent communities, kind of in Georgia and Florida for the most part. And we're currently doing a 4-location storage portfolio as well. So storage is very easy to build. I think it's pretty much the only way to make real money in storage at the moment. Otherwise, you're just sitting holding storage for your quick 10% IRR. And then one of the fun things we have to do as a family office is we do have to invest about $10 to $50 million a year as an LP check. So we're really looking for some more risk-aggressive things. We do a lot of land development, or the LP capital or at-risk money for other people's land development deals. We come in and we take the entitlement risk, we take the zoning risks, not actually knowing if these guys are going to be able to get, obviously there's a plan to get it done, but it does come with the risk of, if it doesn't get done, I'm sitting holding a property that didn't get rezoned. So, but I mean, those IRRs are astronomical for the risk profile. But no, I mean, primarily we are building multifamily built to rent and buying A-class properties in today's environment.
Yeah, that's very good. So first part to unpack there, why A-class properties as opposed to C, B, D? What's drawing you to that asset type?
Just the variables. I mean, let's look at your traditional, everyone bought 19 class for the X number of years, right? That's everyone's go-to 1970s, 60s, 80s value add. But you have to look at the true risk profile of those deals. I mean, you're spending $15,000 to $18,000 a door just to renovate and move it up. And sometimes you're just going from a C- to a C+. Some of these products you can't turn around from a C to a B. So let's be honest about it. But then 2 is look at a repipe. A repipe's $15K a unit, or so you can go down 12, but also look at here. I'll give you an example. We had a property in Daytona Beach, Florida, 288 units. In the first 18 months, I replaced over 150 HVACs that should not have blown up, but they did. And that was what? $450,000, and I budgeted $100,000. So, I mean, there's so much room for error that you can't predict. I only can come in so hard in due diligence. I can't go into every HVAC and get an estimate of the exact date it's going to blow up on me, or go in and find molding, or go in and find a ton of other stuff in there, or roof leaks that I can't see my roofing check. So here, there's a ton of money still made doing that, but just a risk profile. For us, I'm coming in, a lot of what we're buying is 2021 and 2022 product. I still have a warranty on my building. I got no risk whatsoever. Let's also look at the cost of running these assets. I mean, our average cost is about 37 to 39% on a cost basis for A-class versus C-class. I mean, that's a 50% thing. Some people are running 55, 57. And if you're not running well, it's even higher. But the biggest thing is A-class, you're not running to as much of tenant turnover in C-class properties. You're not running to as much delinquency. I mean, we own the August in Friendswood, Texas, right? It's a 2022 product. It's 97% leased. Always got 1 or 2 out there. And today's the 9th, but on the 5th, we were 100% collected across the board. Not even a single dollar out. And it's an ease of use. We focus on other aspects of the A-class thing of walking in, having a core product. Like there's no scuffs on my walls. My floor is clean, polished. We have people who can walk your dog. We have the concierge, like you name it, we have it. But it's just a different type of asset and a way to run it in a more risk-averse profile.
And I love hearing you articulate all those. We share the sentiment, right? We're buying a little bit older, but I think one of the parts that you kind of hit on there is the risk-adjusted return, right? And the collections risk specifically. We can talk expense risk-adjusted return all day long, because obviously something that's older is going to break more than something that is newer, right? So that is the obvious part. But what I'm afraid people don't think enough about is today, especially after a 10, 12-year bull run we've been on, a lot of the value add stuff has been touched 2, 3, 4 times already. And if you just simply look at rent to income ratio, right? You're going in, I see value add being marketed on everything that comes out. You go in and look at a 1974 building that's a C-class and it says value add $200 below rent. Well, guess what? They're at 43% rent to income ratio. So, you want to bet you're not going to be having collections risks, 2 weeks in. So I totally get the risk adjusted return sentiment. And, especially that a wise man, I think it was Rich Fetke told me this, Robert Kiyosaki's definition of an asset, right? Someone who puts money in your pocket an asset is something that puts money in your pocket. Liability is something that takes it away. Well, I would argue that an asset is something that puts time, money, and happiness in your pocket. I don't know about you. I didn't really enjoy running a lot of the lower class buildings that I've owned in my life. So it's anyway, something to think about there, but really appreciate your insight on that.
I was going to add one last thing to it. It's also just the ability to push rent organically. You look in C-class, you do that, you have to fully re-tenant. Coming and looking at these A-class deals or even B-plus properties, 2000 newer, a lot of our tenants, when we come in, we do due diligence, and a lot of times we're able to get a pre-look at the rent roll. These people are able to afford a $200 to $275 rent bump and still be at a 3-to-1 rent to income ratio. So unlike with a C-class, we have to fully re-tenant. We have Life at Spring Estates, the deal up in Houston or Spring, Texas, right?
Yeah.
It's 2009, 390 units. We walked in day one and just bumped rents $125. And we've done it on 10% of the property so far, just because our people can afford it and there has been pushback. It's not worth leaving. We provide a great property, great process, but it's just the ability to actually organically push rents without having to spend mass amounts of money on it and you see that also in the due diligence by ensuring that you have that.
Yeah. And you can even take that one step further. And as you're building new projects, I'm sure you're well aware of this. Really, the only thing different between what was built in 2010 and what's being built today is a little maybe smarter tech packages and maybe an amenity or two. So in terms of dollars injected, if you had to, you can really come in and do some pretty interesting value creating amenities like a smart tech package or an internet situation across the complex, and drive that value, even if you had to justify it. But to your point, a lot of times it's there and they can already pay for it. So where are they going to go? I love that. Well, switching over a little bit to what you're doing on the development side. So you mentioned build to rent. What has gotten you excited about building build to rent communities, which ironically, all these are build to rent communities, but we're talking about, specifically single family residential neighborhoods that are built for the purpose of renting, not selling. So let's talk a little bit about what you're doing there.
A lot of it's just the appetite for it. Like it's at the end of the day, we're looking to come and buy or develop it and sell it to an end buyer. So what is the appetite in the markets? The appetite for a super highly priced C-class value add deal is low at the moment. The Blackstones of the world and all these big PE firms are still dying to mass up large amounts of single residential family because one, there's still a lack of supply. Two, especially now with interest rates, some people are just choosing not to buy because I bought my house in cash here in Naples just recently because it's cheaper for me to have it than pay 6% on a mortgage note. Like I'm not doing, I'll wait not everybody can do that though. Like I'll wait 2 or 3 years and refinance my house. But a lot of people don't want to get a mortgage at 6 to 7% if it even goes up further. So they're choosing to rent. So, it's 2.5 years to break even and owning your home versus renting. That's the number. It can be even further now as interest rates go up, but it's about the average. So it makes more sense just to rent. But it's the last 3 that we have done, the end buyer has put in half the LP equity to guarantee a price at the end of the road. So I've signed an agreement to sell these build to rent properties before I've started building them. And these big hedge funds have put in half the money up front for the LP equity. So it's a give people what they want. Plus, I just believe in the product. I believe in renting. If I didn't have my 3 kids, I would never own a home. I would be renting away forever and having fun. But let's give people what they want. Plus, also, it's the ability to know what my return is realistically going to be. I don't have to focus on appreciation. I don't have to focus on a value add process. I know I have clients who are willing to pay A, B, and C. My cost is this. And it's way easier for me to raise equity from an institutional source. Say, hey, I'm really going to return this rate on capital. Here it is. Here's my cutters on both sides. Guaranteed cost, guaranteed exit. And it's just much easier to raise capital because you're at an institutional level that way.
Yeah, that makes a lot of sense. And that's, I can't imagine a better situation to be in than, basically having a guaranteed buyer who also is invested in the project. So you kind of have taken care of both ends up front. I didn't realize you were doing that. Pretty interesting stuff. So anyway, let's pivot a little bit over to the capital stack you're using, and then maybe we'll come back to build to rent a little bit. But you mentioned using institutional equity as the largest LP investor in your deals. What does your use of capital look like? 'Cause I see you as someone who is, very astute in using, large sources of capital, very reliable and repeatable sources of capital. But that comes with it a necessity to understand the details of the capital stack and how to mix and match different buckets of equity. So How are you structuring things like a build to rent development deal, and where does your money come from?
I'll touch on it in a couple different ways. I'll start build to rent, then I'll jump to multifamily. So for us, like I always admit, one of my biggest challenges is raising smaller LP equity checks. I don't have the database for it. I don't market to it, and it's not my skill set. It's also not what I want to be doing. I love the operational side. I love working with private equity partners that come from that world, and they enjoy us as well. But our average check size is between $7 to $12 million coming into our deals. Occasionally we'll take a smaller one, and occasionally to help with some like friends and family raise. But for the build to rent communities, we're either partnering with a life insurance company that's going to do the debt and equity and take us up to about 92, 94% LTC. And then we'll usually bring the rest of the capital stack there, or find a partner that's like a passive institutional partner. It's going to cost us a lot more on it. So they walk back that structure. Life insurance company, debt and equity, about 92, 93% LTC. They're going to take about 10% of my overall GP promote. I'm then going to come in and put a second slice in there. Afterwards, more of a passive institutional source for probably about that 7% LTC on it. We always put some money in, but just doing round numbers. And they'll probably take about 15 to 20%. So I'm getting over about 70% of my own promote. But I have two capital sources and I'm done with my deal. I don't have any investor reporting. I mean, I have way more reporting. I got 160 pages going out in detail that I'm going to grilled on, but I don't have any of the LP questions like, hey, is my money safe? What's going on? We dipped from 97 to 94. Like, are we okay? Like, we don't do any of those things, but we also get hit on fees. Like, I don't get a 2.5% acquisition fee. I don't get a 2% asset management fee that's not necessarily not deserved, but it's just the cost of my capital. So, and it's not the deal couldn't support those fees. It's just what we're allowed to get by using institutional. If you look more at the multifamily side, what people are really having to do now is most people are really having to change what they buy in today's market, because like our average deal size is $60 to $80 million on the buy side. But let's just say your average buy size is $40 million, right? You used to have a 75% loan or 80% loan for bridge, and you'd bring 10 to $8 million to that deal, right? Now you're getting at most 60%, sometimes 50% leverage. So you're having to bring twice equity, $15 to $20 million. And a lot of people don't have the ability to just magically double the amount they can raise per deal. And they don't necessarily want to bring in 8 co-sponsors to help raise for it. So the people being particular about what they're buying, sometimes they're just buying smaller size deals to only have to raise less. Or a lot of people are having to truly understand institutional pref, which one assesses fees, and then 2, it's going to hurt other LP cash flow. But the benefits of it is also going to help juice your deal because 1, most pref groups don't take depreciation. So all that depreciation gets set aside to your LPs. So you're usually getting well over 100% in most cases by using pref depreciation for the other LPs. 2, they have a fixed rate of return. I mean, we're getting a pref anywhere from 10. If you're a smaller syndicator and you're a little more riskier, you're paying 14. But a lot of that's either set or accrue and current. So I mean, our average pref on our larger deals, I'm paying about 4 to 5% current pay. On a smaller syndicator, you're going to pay about 7 to 9% current and the rest in the back end. So we just did a deal where it was an accrued thing over 4 years. It was 4% year 1, 5% year 2, 6%, and 7%, and the rest in the back end, but allowed our other investors to cash flow as we improve the property. Cash flow. That's kind of key for us. But I'll give you an example of some of the extremes people are putting investors into and where I don't think the deal is worth it. And this year was publicly announced it and put it everywhere. So let's take a look at Reef. They bought a massive 20, it was like 17 or 2,500 unit portfolio, right? Recently, lasted everywhere. Let's look at the first stack. You got first stack institutional debt. I don't know, it's Fannie Frank who did it. The second place was Berkshire Capital in a hard pref position at 12%. Third tier was DLP, absolutely great operator, great syndicator investor, and also an LP capital source at a fixed 17.5% return. And that's second tier pref. And finally, in fourth position, you have LPs who are getting 0% cash flow and a supposed 30% return. But that comes with just such a huge risk. For 1, your promote as a sponsor, and then 2, a risk to your LPs. Because if anything goes wrong on that deal, anything, you got the main lender, you got Berkshire Capital, you got DLP, and I've gone full cycle with DLP. Great person. We're doing a second deal DLP right now, but they're in a prior position. They're not going to be like, oh, the deal went bad. You guys didn't have your cash at the same time. No, like they're taking all their cash and their stuff up front in first. So people are having to financially model these deals to make them work now. And again, that's why we don't do C-class deals, or I wouldn't structure a deal like this, because that's just too much, in my opinion, financial modeling to make a deal work, or just an inability to raise the capital that you need to. So you're having to stack things you don't necessarily want to stack together to make it happen. So that's one of the things, like when I was talking to LPs and they come talk like, hey, Ian, like we don't take a lot of small LPs into our deals, but like, hey, will you take a look? Like some of my friends are like, hey, will you look at this deal? What are your thoughts? And I'm always looking at it like, don't be scared of having pref in a deal. I would say like, don't be nervous about having pref. Having pref can be great, especially if it's structured the right way. I use pref in a bunch of our deals, and a lot of syndicators do. It's great because it gives you a higher return because they take a small return, and so you get more appreciation. But just look how high in the capital stack it is and actually see where your risk profile is in there. Sorry, that was a very long-winded story, but
now that was all very good and insightful stuff about the capital stack. And you're absolutely right. I mean, this is something that you can make returns look artificially great by using the right lender or the right lenders or pref equity groups or JV equity. I mean, you name it in the capital stack. But to your point, when you start seeing equity stacks that are 2, 3, 4, 7, 8 levels deep, the risk is, yes, you may do very, very well on the back end. And look, the capital stack is proportional. If you start with the guy at the very bottom and go all the way to I did my finger backwards for those in video. If you start with the guy at the very bottom and go all the way to the top, the lender is first, right? Which means no matter what happens, they are secured by that property. And if everything goes wrong, they'll take the property, right? But they're going to get their money back first. Well, guess what? They make the lowest amount of money for that reason. Whether it's 2, 3, 4, 7, 10%, they're making the lowest amount of money in the capital stack. And then you have pref sits behind that, and they're just behind the lender making a little bit more money. And the further up you go, yeah, you may look at a 30 IRR, but the chances, you have to start to think about what has to go right for me to see that money or even return of capital. It's return of and return on. So I appreciate all that you just kind of went through there. In our deals, we always use pref as well, but to a lower degree, just because we are dealing mostly with LP investors that are syndicated and they do prefer their cash flow. But tell me if you agree with this statement. You have kind of two mantras of how to make a return on a deal, right? And so if you are wanting to see more of a return up front and throughout the life of the deal and cash flow, you probably want to stick to, syndicated equity and what you can afford there, because you're going to be able to, see some fees up front. You're going to see a portion of the cash flow. The LPs are probably going to cash flow, assuming you're operating well. And then you get the kicker at the end. But if you're able to, it seems like when you can start playing with these larger buckets of money and you can handle their hard or soft prefs on the front end, you may not see little to anything during the hold period or up front, but your payout on the back end can be much, much greater. Do you agree with that statement?
I would.
Yeah. So it's very interesting.
Want to take it's the choice of, do I want cash in hand, a smaller amount as we go along? It's also why people choose to invest in cash flowing A or B class or a brand new property, because the current assets going to produce cash. A new dev's going to have no cash, obviously a higher return. So it's going to go same core principle.
Yeah. And I kind of love talking about this motivations of different investors, because think about it, folks. Who has been able to buy most of these brand new day one assets? So we know Ian's doing it, but a lot of syndicators are not successful in that range because their investors, if they're syndicating LP equity, are expecting some form of current pay or cash flow throughout the hold period. Well, these assets are likely to hold their value. They're likely to appreciate. They're likely to experience organic rent increase with little to no deviation from plan or meaningful rise in expenses or capital necessity. And so the groups that are buying these deals oftentimes are looking 5 years ahead. They're saying, look, I know this is going to be worth more money and I'm going to make a good return here. It may not be a 30, maybe it's only a 15 or a 20, but it's going to be there, right? And so that is why you have such a hard time competing as a syndicator with these newer assets, is they don't need the cash flow. They need the IRR. And that IRR, they'd rather go for something that's guaranteed to be there and not going to suck up all their team's time as a Class C building would be. So super interesting to hear your perspectives on things today. So last question, Ian, then I'll let you get back to your 3 kids because it's weekend time here on the East Coast. What's your take on where we're going? I mean, we see interest rates rising. Yeah, I just did an episode on why that is and unpacked all of that. So, we don't have to go walk back through printing money and inflation and all that, because I think our listeners have heard that. But just Ian's opinion, where do you think we're going? Where do you think we're settling out? What do you think the future holds?
I'll talk about it in terms of, we invest in a wide variety of other asset classes as well. So we see the trends affecting those businesses in terms of debt and equity. You guys are more focused on multifamily. I'll take an approach of what I see upcoming in the multifamily industry. I think we're going to see a lot of people who didn't buy a rate cap 2 years ago struggle when that rate cap comes up this year. You're going to see sponsors who are reliant on a refi to hit returns be forced to sell for a smaller return coming up. And then I see people who bought at the absolute peak and just paid too much, who will have a rate cap for a year and a half, are going to have to sell and break even. But what that's going to do is provide an absolute ton of value. Like, we're looking very, very hard right now. Like, we have, I won't name the asset. It's in Houston. It's beautiful. I bought another 2020 project from the same company, just a different location. They came out at $245 a unit, and I was way overpriced for me at the time. And we put in a price of $190K for it when they wanted $240. And I was in Houston a couple of weeks ago, I think I was telling you, and they called me like, "Hey, so you're in Houston. I know you bid $190 for the property. Do you want to come do a tour and look at it?" And I'm like, "Guys, that's $50K in like 3 months. You just dropped." I mean, I'm not at $190 now anymore. I'm like probably 170s, 175. But I mean, that's probably at cost, or maybe 5 G's below cost for them. So I think you're going to see a ton of opportunity to buy things in Q1, Q2, and Q3, but just slow persistence and waiting for the right deal to fit what you like as a syndicator and what your LP investor wants. There's going to be a wide range of brand new product that these equity groups don't want to sit in a deal. Like, they've been there for 3 years already, holding as you built and leased up. They have to exit. Their plan is for 3 years. And some are like, "Okay, we understand this deal crashed. Give us our money back. Next deal, let's go." Because it's going to sit here for another 2 years. We'll make 2%. It's not even worth it. Let's just take it out and start making 20% again. Or 2, you have a bunch of the value add deals that people got jammed up in because they didn't have a rate cap, and they just have to stop and exit out of for safety reasons, which is great because it's always better to exit out, and it's a return of capital versus risking that for return on capital. So whether you want a C-class value add, a brand new property, whatever it is, in Q1 and 2 especially probably in Q3 a little bit, you're going to have a choice for a variety of deals. Nothing like 07, 08 where you buy pennies on the dollar, but things that you probably could have bought a year ago. Like, I'll give you an example, Jacksonville, Florida. C-class stuff trading for 165, 170 door is going to come back down to that 125, 130 range. So you're going to see a decent gap. And the market's obviously go back up with appreciation, but just be ready and patient, and great money for sponsors, syndicators, and great money for LP equity coming up.
I love when other people echo the thoughts that I've been preaching on this show for weeks and weeks and months as we've seen this coming. But I agree wholeheartedly. And folks, the last thing I'll say on the topic, it takes about 6 to 8 weeks, in my experience, for buyers and sellers to readjust to a change in the market, whatever that is, because anything that affects value, financing, price, it just takes time for sellers to realize, oh, what I could have gotten in January, I can't get today. So maybe I'll hold for a few months. Well, anyway, 6 to 8 weeks later, we've had a change nearly every 5 weeks since January. So as you can imagine, and Ian's example was exactly that. We have seen nearly, in some cases, 25 to 30% buyer-seller price discrepancy on newer assets. Maybe not as much, but point is, be patient, keep making offers, keep being relevant. And when those people are ready to sell because equity's forcing them to, or they're choking from not having a rate cap and paying 8% interest when they underwrote 4, all that kind of stuff is going to come to the surface, and you just got to be ready to pick up value when it's there. So, Ian, thank you so much for joining us on the show today. Valuable insights. Just hearing someone of your stature talk, it's a value for everybody. So I really appreciate you, man.
Thank you for having me on, Chad. I appreciate it a lot.
All right, everybody. So before we get off the show, don't forget, if you got any value out of this show, scroll down, leave us a 5-star review and a thoughtful comment. That's the only way we grow this show and get to more people just like you. So help us help you, help us help your friends. we'll get it done. You can also follow us via our parent company on Instagram, Facebook, and LinkedIn at Team Quattro Capital, one word, no special characters, or simply by visiting thequattroway.com. So Ian, before I let you go, what is the best way to get in touch with you should someone have any sort of a, need to chat with you or perhaps conduct some business or something of that sort?
We're very, very active on social media. It's just Djuric Family Office on Instagram, TikTok. I'm very active on Facebook as well. Have your office, DjuricFamilyOffice.com. But social media is always the easiest way to get a hold of us.
All right. Fantastic. Well, thanks for coming on the show, man. Everyone else, this has been another episode of the Real Estate Runway Podcast. Until next time, over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.